Today we're going to be going through CECL and loan modifications. Over the past 18 months, I've definitely seen more clients reaching out to us, discussing that they're, having to do some modifications. They're having some borrowers with financial hardships where they're having to make concessions. And I want to go over some of the key things to consider when you're working through some of the new modifications under CECL. All right. Now, in today's webinar, we're going to talk about loan modifications, kind of being able to identify and define when those should be used. We're going to talk about the non-significant designation under CECL. We're going to look at reviewing best practices for internally how you should be looking at loan modifications, also understanding the allowance on them. We're going to spend a good portion reviewing the disclosures under CECL for modified loans. I think that some of the updated guidance compared to when we were using TDR, disclosures have definitely gotten harder, not easier under CECL. So we're going to spend some time really understanding the changes there and what you all are going to be required to do for your disclosures for modifications. And then just kind of, again, working through strategies to make this as efficient and as simple as possible. So first, we're going to start off with loan modifications, and we'll kind of define this real quick, right? Why were we doing this? First thing is just regulatory scrutiny, right? If you're not doing your disclosures correctly, it can just lead to reportable findings. Like I said, there is a complexity to the disclosures that are required, much more complicated than the old TDR disclosures. So I really want to go through these with the groups so that everybody understands how these disclosures work and the kind of information you're going to need to get those created. And then lastly, is just this interdepartmental synergy, right? Making sure that the accounting department is working with other departments who are making the modifications, getting clear communication to them when modifications are made, and the specific changes to the contractual terms that are being made, because all of those things are going to end up being needed to be tracked and then disclosed on an annual basis. All right. So first thing is just defining a loan modification, which really is a more than insignificant modification made to a loan agreement where the borrower is experiencing financial difficulties. So really kind of the same definition we've always had for modification. The one thing I guess they do specifically address here is something that's more than insignificant. So any modification that is going to have a more than insignificant impact to the expected cash flows of that loan. Now, some of the different types of modifications we're going to go over today: interest rate reductions. So right, in a lowering of the interest rate compared to the initial interest rate that was contractually given. So an example here would be a 30-year mortgage with a 7% rate, which is temporarily reduced to a 4% rate for 1 year. We also will go over term extensions, right? Extending the maturity date of the loan and generally lowering the required principal and interest payments. So we have a 5-year commercial loan and the term is extended to 7 years. And with that, changes to the payment amounts will be given to the borrower, generally lowering those monthly payment amounts or whatever the payment frequency is. Principal forgiveness. This is where a portion of the loan principal is reduced, and generally lenders will agree to forgo any given amount. There's usually a policy of how much can be forgiven. So we'll talk a little bit about that as well. And then lastly, payment delays. And within payment delays, I'm going to include skip-a-pays or forbearances. So this one is really, right, any deferment of the payments that for a specific period of time. The reason I bring up skip-a-pays, which is generally practiced by credit unions, sometimes we see that an institution may do 2 skip-a-pays within a given year. And if you think about if a borrower actually acts on that twice a year, and let's say they have a 6-year term loan, after 6 years, we've now extended that loan out over a year. If they're making, forbearing the loan one payment twice a year, it really does extend the loan out pretty significantly. It's hard to argue when those are being repeatedly made. That no longer is an insignificant modification. I kind of generally like to say if the skip-a-pays are happening once a year, probably could be argued maybe not significant, but if they're doing it more than once a year, it could be argued that those are a significant modification to the loan. So we'll keep that in mind, as generally skip-a-pays are not considered in modification by most of our institutions, but they should be considered if it really is reaching a higher time frame than maybe you would expect. All right, so first question of the day: which of the following is considered a loan modification? A change to a loan's terms initiated by the lender with the borrower's agreement, change to the original contractual term of a loan agreed upon by the borrower and the lender when their borrower is experiencing financial difficulty and the modifications are more than insignificant, any change in a loan's terms, or change that only affects the interest rate. The correct answer was B, a change to the original contractual terms of the loan agreed upon by both the borrower and the lender that occurs when experiencing financial strain and the modifications are more than insignificant. Good job, everyone. Most people got that right. All right, next we're going to get into accounting and evaluation under CECL. I'm going to start, we're kind of going to define TDRs, which was pre-CECL, and then we're going to talk about the modifications moving forward. The first thing, I guess, with TDRs, right, these were under the incurred loss model, granted when there was a concession to a borrower in financial difficulty, so pretty similar to the modification definition today. Remember, treaties were taken out of your pool-based calculations under the incurred loss model, and really GAAP would have had you run a present value calculation on the expected cash flows of that loan to calculate the allowance on any TDRs. This was using the loan's original effective interest rate and generally resulted in kind of that initial impairment. Now, one of the reasons I brought up the calculation here for present value loans under CECL is if you're doing a discounted cash flow model, you're running a present value calculation in your CECL model on modified loan, and you're applying adjustments to those cash flows based off of charge off and prepayment risk. So it's an even more kind of conservative approach to your expected cash flows than what you would have done under the incurred loss model running a present value calculation. And the reason I'm bringing this up is a lot of times we get the question, well, for the modified loan, should I individually evaluate them or run them as collateral dependent, right? Remember, if you're using a life cycle calculation in your model today, in most cases, you probably don't need to pull that modified loan out of the pool and run an individual evaluation or collateral dependent calculation. But there are instances where you should consider doing that. And we'll go over that in a second. Now, modified loans under CECL, generally we're going to remain in their original pool for calculating the allowance unless, and this is those instances that I was mentioning, unless the loan is in foreclosure, then it would be a must. It must be run as collateral dependent. We'll talk a little bit more about that in a second. And this really eliminates that separate TDR classification for impairment and running those calculations using the present value method like we used to do under the incurred loss model. So keep that in mind. Now, talking further about these loans that should be potentially run as collateral dependent or individual evaluation. And this goes back to what is in the standard for CECL, right? Any loan that is in foreclosure or reasonably expected to go into foreclosure, the standard requires you run that as collateral dependent. So for modifications, if a modification is made and either the loan is currently in foreclosure or ends up going into foreclosure, that loan should be based off of its fair market value for its expected reserve calculation. Additionally, for other loans, so remember what the standard says for this, it's a must if the loan's in foreclosure. However, you can also use the collateral dependent method for loans where the borrower is experiencing financial difficulty, it's secured by collateral, and you believe that collateral is the best representation of what your expected loss would be. So must if it's foreclosure. You can also use it in the situation I just described. Then lastly, individual evaluations can be made on modified loans. Again, going back to the definition within the standard of when this should be used, it would be that modified loan now has a risk profile so intrinsically different from the pool it resides in, that pool's risk doesn't capture the risk of this one individual loan. In those situations, it would also then be appropriate, or you could build that in as an individual evaluation. So just keep that in mind. There really are definitions. You shouldn't build into practice that every modified loan you have needs to be individually evaluated or made collateral dependent. It should be a case-by-case basis based off of those individual attributes of the given loan. Very good. All right, next question. Under the previous incurred loss model, how is a troubled debt restructuring loan primarily measured for the allowance calculation? By its fair market value, by its original loan amount, by its amortized cost basis, or at the present value of expected future cash flows discounted at the loan's original effective interest rate. The correct answer here was D, at the present value of the expected future cash flows discounted at the loan's original effective interest rate. So again, we got about 64% of those got that right. Now remember, that goes back to my reasoning under CECL, why we're already doing a more conservative calculation on any TDRs with the CECL calculation itself. Pretty much in any case, right? The discounted cash flow method, a PD method, most of these models are going to have a more conservative approach than what would have been expected in the incurred loss model for TDRs, just simply running the present value of the expected cash flows. Okay. All right. Next, we're going to talk about modified loan policy. All right. So one of the things institutions may want to consider is if you have a CECL committee, maybe kind of also bring in some sort of modification committee or understanding which groups or departments need to be included in any things related to modification. right? Again, like I said earlier, one of the things I have definitely seen is, as we're working with different accounting departments or whoever it may be, they may not even be aware that modifications are being made on loans. And that's problematic, and mostly for the disclosure reasonings that the accounting teams have to do. But it's really important that modifications are tracked internally, that information shared with the groups that are going to be creating the disclosures, that, members are considering a policy for their modifications and when modifications should be made. So we're going to go through some of those specific, definitely for the most of the people we work with, it's really just making sure you're getting aware of when modifications are made. Are you able to track them so that at your end, you're able to do your disclosures without having to go research a bunch? You've already got it tracked and well organized and ready to be disclosed. And these are just kind of some guidelines. These, we help institutions with their modification policies periodically. And here's some of the things we've just kind of seen built into policies, just examples, just general examples, nothing you have to follow. Right, given the hardship nature of these requests, you're generally going to see that there are going to be exceptions to your underwriting, right? Whether it's debt to income exceptions, debt service coverage ratio, loan to value, interest rate, term limits. There's generally some sort of exceptions that are being made in order to modify the loan to make it more affordable for the borrower. Also, you may want to include some just kind of specific provisions. One of the ones I see a lot is based off of some sort of dollar amount, generally of about $250,000. Any modification to a loan of that size has to go through kind of a little bit more of a review process, kind of has to be signed off by more members in order for modification on that size of loan to be made. We've also seen that, some people may build in that they won't do principal forgiveness modifications, or that modifications can't be made more than every 12 months, or maybe building in a policy that your skip-a-pays can't be done more than once annually. So there's just some things you consider, how to do the modifications, when to do the modifications, what your exceptions will be. And those should all be considered when kind of drafting those guidelines to ensure that everybody's on the same page here as well. All right. Going to go through just some of the financial difficulties. These is not an all-inclusive list, but right, if borrower is in default, generally you could believe they have showing signs of financial difficulties. Definitely if the debtor has declared bankruptcy, that would be a clear sign that they're experiencing financial difficulties. Sometimes we'll see that there's like a growing concern. Maybe their accounts receivable doesn't, hardly capture what's outstanding, or the collateral has become significantly downgraded, whatever the case may be, that there's just concern that the debt will be repaid. If there's debtors has securities that have been delisted from an exchange, potentially that's signs of financial difficulties. Maybe based off of future expected cash flows will be insufficient to service all of the debt, or financing from other sources at a market interest rate for a non-trouble debtor. So just kind of understanding when does that definition really apply to the modification in terms of the borrower having experiencing financial hardships. Now, what we've got here is kind of an example of a policy that we kind of just create, a sample policy we created. We've broken this out. This is really trying to say, all right, what meets the definition of a more than insignificant modification? And we've broken this out by different types of loans at the top. So you see, right, consumer, loans under a 10-year term, over a 10-year term. Then we've got commercial real estate. Then what we've done is we've broken this down underneath by each of the different exception types. So first, term extension. So what we're saying here is, right, first one, greater than 3-month term extension qualifies for a more than insignificant modification that would need to be tracked and disclosed. For the ones that are 10 years older, consumer loans 10 years older, 6 months greater, and so forth. So we're just kind of defining how many months is that extension, can that extension be granted before we're going to consider it a more than insignificant modification. Rate reduction. Generally, most rate reductions are going to have a decent impact unless it's very, very small. In this case, we've kind of built this example with any rate reduction would be considered a more than insignificant modification. Additionally, any principal forgiveness would be considered a more than insignificant modification. And then lastly, payment delay 6 months over the life of the loan. So any payment delays greater than 6 months over the life of the loan. Again, going back to skip-a-pays, right? Got a 7-year term loan and they've done it every single year, even once a year. After 6 years, that may be a more than insignificant modification. So understanding or creating this kind of documentation that can be shared throughout all departments can be really great. And then being able to document these modifications and understanding the kind of impact to not only your CECL allowance calculations, but also the disclosures you're going to have to do. And now we've put in a couple other modifications that you may want to consider addressing within your modification policies. This would be debt consolidations, right? So any modification due to debt consolidations being made. Additionally, we brought in the skip a pay, right? So if the skip a pays, I really kind of, again, built this example with what I've been saying the whole time, right? Any modifications made more than once a year may need to be considered a more than insignificant modification on the skip a pay side. And that could also be included with forbearance, something similar. All right. Next we've got, and this goes back to kind of tracking everything, right? One of the things, if we can get our institutions, at least the ones that are with ARCSys, if we can get you to load a modification code within the system, we can help you generate the disclosures at year end significantly easier than if you have no modification codes tracking the modifications in your data sets. And this is really just an example. This doesn't have to be exactly like you build yours, but really what it does is it identifies and tracks, it creates a coding system to track the different types of modifications that can be made, right? So in the first column, you're going to see single or no modifications, right? 0, no modification. 1 would refer to there's been a term extension. 2, interest rate reduction. 3, principal forgiveness. And 4, payment delay. As we're building this, we also then realize, you know what? There are situations where we may have a modification where there's a term extension and an interest rate reduction. So in column 2, we've got all the different combinations of 2 or 2 specific modification types being made to the loan. So again, 5, TE stands for term extension, IRR, interest rate reduction. 6, term extension, principal forgiveness, and so forth. And then lastly, if there are more than 2 modifications, we've also created a classing structure that would be used up there. Generally, we're not seeing that many modifications made on a loan, but it is possible. So you should be able to track these because all of these will have to be disclosed separately, right? You are going to be required to disclose separate pieces of this based off of how the loans were modified. You don't do one disclosure for everything. It's all based off of the modification types that have been made. And that'll make a little bit more sense here in a second when I go through some of the disclosure examples. And again, key point to this, you should build something like this internally. Our recommendation would be to then get that at the loan level. So like into your core system, some way to track it in your core. And then lastly, get that information then input into ARCSys so that we can help you automate some of your disclosures at your end. All right, next question. If a modified loan is in foreclosure, how must the lender evaluate the expected loss? Using the present value of expected future cash flows, using the collateral dependent method based on the fair market value of the collateral less the cost to sell by keeping it in its original pool, or by using a pool-based allowance calculation. So again, modified loan that is in foreclosure. All right, the correct answer was B, using the collateral dependent method based on the fair market value of the collateral less the cost to sell. And remember, modified foreclosures is when it's a must. You must use the collateral dependent calculation for loan that is either in foreclosure or reasonably expected to go into foreclosure. That's the must. You can also use it again when a borrower is experiencing financial difficulties, is secured by collateral, and you believe the fair market value of it is the best estimate of what you could potentially lose on the loan. Very good. All right. Next, we're going to get into documentation. We're going to spend some time really going through examples here. I think this is the hardest part. Their disclosures are not easy, and especially one which is the financial effect of the modification. That one can be extremely difficult. Now, really kind of what I've been going through today is kind of getting us prepared for the disclosures. All of the understanding of when to make the modification, creating the policies, creating a coding structure, all of that is to really kind of build good policies and procedures that'll help you all when you have to disclose these items. That part can be, it's just trying to set you up for success for the disclosures because they can be time consuming. Now, why is there an importance of accurate documentation, right? Legal and regulatory compliance, right? Proper documentation, first line of defense in an audit can kind of support that your modifications were made appropriately and followed your policies. Also, again, to support these financial disclosures. I cannot tell you how many times over the past couple of years I've talked to institutions who, when kind of they were starting to work their financial disclosures, they didn't believe they had any modifications, but it really wasn't that they didn't have any modifications. They just were never notified that any loans were modified. So, an empty modification disclosure when modifications are actually being made It's just kind of right. There hasn't been that kind of internal processes built so that it's communicated clearly throughout so that everybody knows their piece is being taken care of appropriately. All right. So key documents in this is the modification agreements, right? So understanding making sure that you have the legal binding documents for the new terms, underwriting analysis and approval memos. So any internal analysis that justifies the modification and the approval of that concession, borrower communication. So emails, letters, signed agreements with the borrower. And then lastly, update of financial information. Also, again, kind of if you think about key documents that more are internal for internal processes would be again, kind of this modification coding. If we can get those codes into the core data sets and again, upload it into the system, we can really help you make a lot of this painful disclosures a lot easier. All right. Next, we're going to get into some actual disclosure examples and kind of really define each of the different disclosures and what we have to do. Now, purpose of disclosures, right? The CECL model has altered the disclosure requirements for modifications. Again, they've introduced these new categories. So for each different modification type you've made, you've got to break down the disclosures by those modifications. And again, a reminder to the group, the term troubled debt restructuring is no longer an accounting concept under CECL. So the specific TDR disclosures from the old model are really no longer required. And you can always reference FASB ASC sections 310 and 326 if you want to read more about the specifics of these modifications and the disclosure required. All right. So the first disclosure we're going to go through today is modification made to borrowers experiencing financial difficulties. Really, this one's probably the simplest. This disclosure just requires present a general overview of the modification activity throughout the year, showing the total volume of the modifications, again, segmented by the type of modifications, by term extension, interest rate, reduction, payment delays, or groupings of any of the sort. The next one is financial effect of modifications made to borrowers experiencing financial difficulties. This one is by far the most difficult of all of the different disclosures. You have to actually assess and doc the actual financial impact that you as an institution now have based off of the modification that was made. So, right, whether it's basically defining how it impacts your cash flows down to a rough dollar. So in order to do that, you really have to kind of look at the original terms of the loan, understand the modified terms, run cash flow present value calculations, things of that nature to really assess what was the impact because of the modification. You also have to disclose the amortized cost basis, right? So not just the balance of the loan, but the amortized cost basis. So including deferred fees or costs associated with those modified that have subsequently defaulted after the modification was made. And then lastly, they do also have just a pretty simple one that goes over just kind of the payment status, right? Current 60 to 89 days delinquent, 90 days delinquent and greater. That one is not too difficult. The hands down, the hardest one is the second one I listed, the financial effect. That one can be hard. Now, again, if we can get these types of codes into the ARCSys system, we can help you make the process of building the disclosure reports on these much more easy, just using kind of a BI tool and grabbing the information we need in order to really run these disclosures. The financial effect one does take a little bit of manual work no matter what, but I'll kind of go through that in a second. All right. Now, this is the first one. So, right, this is the loan modifications made to borrowers experiencing financial difficulties. Now, what you're going to see here is we've broken out, and these are just 3 different examples of modification types. So you're going to see term extension. We're going to have underneath of that, the different loan pools or the different segment classes. We have the amortized cost basis at year end for that specific pool and for that specific modification type. And then we have also then disclosed the percent of the total class of the financing receivables that modified balance makes up of the overall pool. Then we have payment delay. So same sort of thing here. We've got our different pools. We've got the amortized cost basis at year end and then the percent of the total class. And then lastly, term extension and rate reduction. Now, these are just, again, examples, right? You could have made, my list has 15 different possibilities of modification types. So generally, you're not going to be making that many different modification types throughout a year, but it is possible that you could have to do this 15 different ways if you're making a lot of different types of modifications. Generally, we're going to see that less than that, probably somewhere between like 3 to 5 or 6. But again, it's important to track all of these different types of modification types at the loan level because you're now required to disclose by modification type. Please remember that. That is extremely important. Understanding the modification type goes directly into these disclosures. All right. The next one we have is the financial effect. And this one we'll spend some time on because this one is definitely the most complicated of them. Now, what we have here is term extension. So what we've done again for each pool is we've listed out the balance of the loan. Then what we've done is we've put in the original term. Then we have the modified term. So what we've done here is then just document what is the actual impact then, what does that affect to the future cash flows based off of these changes that were made. And we have to repeat this for each different pool and for each different modification type. So this is where you kind of really have to get into the loan level detail and start understanding, right? How did we actually impact our cash flows by making these concessions to the borrower? And then you have to document those specific concessions. Now there's different ways to look at that, right? Or I guess there's different ways that you could present this. This is just an example. It doesn't have to be exactly like this, but in some way you have to get over what that financial effect is. And you can see, I mean, this is a pretty good way to do this. It just kind of goes through kind of what all these changes were, really tracks and documents how the loans were modified and then put in here. Now, where this also gets complicated, right? So let's say we go back to this consumer new auto. If I have 6 different new auto loans that I've modified within that new auto pool, I can't really take this approach anymore, right? This is just really kind of documenting one loan. In the case where you have multiple loans within one of these financial effect classes, then you have to start doing things like weighted averages, right? So understanding what was the weighted average term increase or what was the weighted average rate change. And then building your financial effect, again, based off of more of a holistic approach versus just one individual loan. You would not want to list out each individual loan within this disclosure if you had multiple loans within that one grouping. So it can be, again, really tedious then to kind of identify all the loans, calculate all the changes to each individual loan, calculate weighted average on those changes, and then try to understand the financial effect of multiple modifications that were made throughout the course of the year. Again, this is where I think the most complex part of the disclosures comes from this one individual financial effect disclosure. All right. Next, we're kind of just go through an example for payment delay. So again, we've put in the principal at time of modification. We've then documented the cash flow impact for both the principal and the accrued interest. Then kind of, again, what is the financial effect of the concession that's being made? Again, when you have multiple loans that are within one of these class categories, you may again have to do some sort of weighted average to really understand or kind of simply document the financial effect within the specific disclosure type. So just like all the other disclosures, breaking it down by the modification type, then by the different class levels, and then those individual financial effects that drill down by that degree. All right. We're going to do one more of the financial effect ones because, again, I think the other ones are much more straightforward. Here's one where we've got a term extension and rate reduction. So give me one second. I can't remember if I did any examples where I had more than just one loan. All right. So in this case, again, what we've done here is we've documented really kind of what the modification was, right? So we've documented what the rate reduction was, what the term extension was. We've documented the impact to cash flows, the impact to accrued interest. So really kind of documenting the impact to the receivables. And then we've lastly documented the effect. In this case, and this is a good one, just kind of documenting, right, how it impacts your cash flows moving forward. And whenever you have combinations, it's just adding in kind of one more thing that you have to review. So in the prior two, right, when we had a term extension, all I've really got to do is understand the impact of the term extension. Or with payment delay, all I've got to do is understand the financial effect of the payment delay. In the case where there's multiple, now you've got to understand the impact of 2 items and kind of clearly document the effect of not just one modification to a given loan, but the impact of 2 or more modifications to a given loan. All right. And this next one is just payment status of loan modifications made to borrowers experiencing financial difficulties. This is the one, again, we're going to have to break it out by the different modification types. So interest rate reduction, payment status, and so forth. We then just kind of have to put just what's current. And again, this is only those loans that are modified. So what's current, what's 30 to 89 days past due, and then what's 90 days past due and greater.
Hey, Justin, we have a couple questions that came through.
Okay, go for it.
So, if you do a modification and reduce interest or extend term by recapitalize the own interest, is that a modification? Technically, over the life of the loan, that I did not make any monetary concession.
Concessions? Well, I think if it's going to be kind of resolved, I mean, that's even in the policy. Let me go back real quick and kind of show my example for a second. Hold on. This was in the slides. So one of the things I put in this modification example here, kind of building kind of the terms or the policy that you would have with the specific kind of 3 months for term extension, any rate reduction, and so forth. One of the notes I have here is kind of unless all payments are cured at the end of the 6-month period. So if they aren't ultimately going to make any concessions because things are going to be cured after a certain time frame, yeah, I think then that could be argued it is not a more than insignificant modification. It would not need to be considered kind of or tracked as a modified loan. Again, if you have a policy like this, just make sure you're actually adhering to it. So if you put in 6-month period, make sure it's 6 months. You may want to, if it's not going to be 6 months, maybe then you do consider it a more than insignificant modification. The reason I kind of use the 6-month period here is generally when you're making a modification, it is because they're showing some sort of financial difficulty. So if the expectation is, that things will get better in 6 months, but then 6 months come and they haven't got better, maybe that's the time when the modification kind of then stays. You will end up taking concessions, and then that modification gets tracked. So just keep that in mind. That's a good question. But a good way to approach this is right. Eventually, if things don't get better, the modification stays. Even if you're expecting it to be cured, then you should then at that point in time make sure it is tracked as a modification move. Sarah, do we have another question?
Yes, we have a couple more. When coding modifications, is it necessary to keep track of the original loan classes?
Well, okay, so that's another good question. So this shouldn't replace your loan type codes or purpose codes, or whatever your internal coding structures are today. It really, I mean, I guess in a perfect world, it would be an additional field within your system that you're tracking specifically just modifications within. If that is not possible, let's say your core system doesn't have any additional fields, which is generally rare, but could be possible, then it may be just something you need to track outside of the core system. Maybe just have a working Excel spreadsheet where you track, year to date, what the modifications are and what the codes are on those loans. That would work well as well. And so, so I think it is very important to keep track of the original loan classes. We don't want to replace, make a new some modified loan code. So yes, I think it is important to keep the original classification and really make this a separate classification on top of what you already have. And do we have more questions somewhere?
Yes. Are these tables of modifications made during the year or the total modifications on the books?
No, it's the modifications year to date. So it's every modification made throughout that year.
And one more, what do you see in practice for loans going into collateral dependent status? Certainly, if a loan is actively in foreclosure with CD, what about the various ages of delinquency?
That's a good question. I guess, I mean, of course, if they brought up foreclosures, you definitely want to have any foreclosure run as collateral dependent. When it gets to that other situation where it's you can use collateral dependent if the borrower is showing signs of financial difficulties. I think I have seen some people say, build in their policy that anything over 180 days delinquent that's secured by collateral will move to a collateral dependent calculation. I don't think the standard requires you to do that, but I've seen that been built in policies. I generally think it's a good approach to, if you've done the fair market value analysis and you have a reasonable expectation of loss, you can always, at least in the ARCSys system, you can actually look at what your allowance is on a given loan. And sometimes when you have a real significant expectation of loss on a collateral dependent or a loan secured by collateral, it's probably a good approach then to kind of build that one separately and get a realistic expectation of the loss you're going to incur on it would be. So I think kind of best practices would be to kind of do the initial fair market value analysis, understand what your expectation of loss is. And if it's significantly different than what you're expecting in your current CECL calculations, then to go build that collateral dependent calculation on that loan and reserve for it separately. Good question. All right. So we kind of went through the amortized cost basis, breaking those out by the different delinquent buckets. And again, this is just for modified loans, not for the entire portfolio, just the amortized cost basis of those that have been modified, and again, broken out. And then last modification that you have to do is then building in the amortized cost basis of loans that subsequently defaulted after they were modified. Again, broken out by the different modification types, and then the amortized cost basis at year end of those loans that have modified or have subsequently defaulted after being modified. Now, again, like I was bringing up earlier, and I'm going to go back to the first disclosure real quick. If we can get either codes loaded into our system that specify the type of modification, we can automate this report. We have all the data, right? Really, all we need to know here is the amortized cost basis of the loan at year end. We have that information. We need to know what the modification type is. If we load codes into the system that track the modification type, we have all of the information we need to then go and run this disclosure based off of the data set you're actually loading on a monthly basis. We can also, calculate what the percentage of the pool is for those modified loans. When we look at the payment status of loan modifications made to borrowers experiencing financial difficulties, again, we can go, as long as you're loading days delinquent in our system, we can go grab the balance at year end for each of these loans and put it into these buckets. So we have all of the information in ARCSys to automate this report. Lastly is this one, right? The ones that have subsequently defaulted. Again, as long as you're loading days delinquent in our system and we have all of your loan data for this year, we can automate this report. We can go track and pull out all of that information from your data sets that are loaded. So these 3 reports are very easy to automate. And this is something we can help you with and create custom reports for you moving forward, as long as you're loading those modification codes in our system. The ones that are hard, again, are the financial effect. I have not figured out a super easy way to automate all of this. We've got some ways we've automated specific information we need to pool, like the rate prior to modification, the rate after modification, the maturity date before and after, things of that nature, so we can see the changes that were made at the loan level. But then kind of some of this analysis and just a lot of this is kind of just building a narrative of the specific effect of the modification. So there is some manual work that has to be done in these. However, when we can get the data, there's a lot of things we can pull out of those data sets to make this an easier disclosure than it is trying to research all your different modifications individually and not having a good data set through time that you can understand the changes of these 4. Let me finish off with our last question for today. Which of the following is an example of a term extension loan modification? A lender agrees to forgive $25,000 of a $5,000 commercial loan. A borrower is allowed to skip 3 consecutive monthly payments on a car loan. A 5-year commercial loan is extended to 7 years, or a 30-year mortgage with a 7% interest rate that is temporarily reduced to 4% for 1 year. What is the example of a term extension? All right. The correct answer was C, a 5-year commercial loan is extended to 7 years. If you're not currently bringing in modification codes into our system and you're interested in doing so, please reach out to one of your ARCSys representatives. We can get you some information on the best practices and how to do that. And get that set up for you moving forward so that we can help you automate some of these disclosures and make your life a little bit easier when having to do these. Additionally, if there's any of the group out there who is interested in seeing our modification kind of example policy, we have one drafted. We'll be happy to share it with you. Again, just reach out to anybody, any of your ARCSys representatives, and we'll make sure to get you over that sample policy. And we'd be happy to discuss this further with any institutions who are looking to make changes to make this a better process for them on a future basis. So just reach out if you have questions or you want to make changes in the system to address some of the items I've gone over today. We'll be happy to meet and get that done. I guess. Any final questions?
There was one more question. What is the purpose of the disclosure requirements for the financial effect of modifications made to borrowers experiencing financial difficulties?
Well, I think before it helps you understand how big of an impact these modifications are having to the institutions and kind of expected cash flows. Really, everything with CECL is cash flow related. So the disclosure is meant to identify how the modifications are impacting your cash flows. Everything with CECL kind of revolves around understanding those future cash flows and understanding kind of what your expected lifetime losses are. And even though, when you make a modification, you're not necessarily writing off the loan. I mean, you potentially could in the future still, but you are reducing your expected cash flows in almost all cases with modifications. And it's to disclose the impact of those changes to the cash flows. Well, I thank everybody for joining us today. Everybody have a good day and just let us know if you have questions.